Right now, there is a giant hole in your wallet, and it is exactly 4.99% wide. For the last century, the American banking system has operated on a single silent agreement. You give them your money for safekeeping, and in exchange, they pay you almost nothing. It was a fair trade when the world was slow and information was scarce. But in 2026, that trade has become the most profitable arbitrage in the history of capital. If you look at the Federal Reserve's current data, the risk-free rate of return in the United States is sitting firmly at 5%. This is the interest the government pays to anyone who lends them dollars. It is the baseline of the global economy. Yet, if you look at your savings account at any major commercial bank, you are likely seeing a return of 0.01%. Where's the other 4.99% going? It is paying for the glass towers in Manhattan. It is paying for the private jets at Davos. And most importantly, it is paying for the lobbying firms in Washington, D.C. that ensure you never get a better deal. The banking business model is not complicated. It is a retail operation. They buy money from you at a wholesale price of 0 and sell it back to the government or to mortgage borrowers at 5, 7, or 10%. The difference, known as the net interest margin, is the oxygen that keeps the banking industry alive. But that oxygen is currently being threatened by a few lines of open source code. In late January 2026, the tension between the old world and the new world finally boiled over. During a private coffee meeting at the World Economic Forum, Jamie Dimon, the billionaire CEO of JP Morgan Chase, reportedly lost his composure. According to witnesses and reports from the Wall Street Journal, Dimon pointed a finger directly at Coinbase CEO Brian Armstrong and told him, quote, "You are full of shit," end quote. This was not just a rude comment. This was a king witnessing the collapse of his moat. Jamie Dimon is not angry because crypto is a scam. He is angry because stablecoins have figured out a way to give that 5% interest directly back to you. And if that happens, the entire multi-trillion-dollar banking industry becomes a relic of the past. This is the story of the war for your 5%, a war that involves secret government reports, rigged legislation, and a desperate attempt to keep the American public trapped in a system that stopped serving them decades ago. To understand why a billionaire would scream at a tech CEO in Switzerland, you have to understand how a stablecoin actually works. Despite the complex branding, a regulated stablecoin like USDC is incredibly simple. WS. WS. It is a digital token that represents one United States dollar. But unlike the digital dollar in your bank account, which is just an entry in a private ledger, a stablecoin is backed one-to-one by actual assets. When you buy a stablecoin, the issuer takes your dollar and does exactly what a bank does. They buy United States Treasury bills. These bills earn 5% interest. The difference is in the distribution. A bank takes that 5% and keeps almost all of it, handing you a single penny at the end of the year as a courtesy. A stablecoin issuer, however, has much lower overhead. They don't have thousands of physical branches to maintain. They don't have 40 layers of middle management. They can afford to pass that 5% yield directly to the person holding the token. This is what the banking lobby calls a systemic risk. But if you look closely at their definitions, a systemic risk is often just code for a loss of profit. In early 2025, a leaked internal memo from a major Wall Street trade group described stablecoins as, quote, an existential threat to the deposit base of the commercial banking system, end quote. The logic is simple. If every American realized they could move their savings from a 0.01% bank account into a 5% stablecoin wallet with the same level of safety, the banks would lose trillions of dollars in deposits overnight. This is what economists call a bank run, but in this case, it's not a run caused by fear. It's a run caused by math. The banks are currently holding over $17 trillion in total deposits. If even 10% of that money moved to stablecoins to capture the 5% yield, the banks would lose $1.7 trillion in cheap capital. They would be forced to actually compete for your money. They would have to raise their interest rates to 4 or 5% just to keep you from leaving. And if they did that, their record-breaking profits would vanish. This is the hidden reality of the 2026 economy. The banks are not competing with each other to give you a better product. They are cooperating with each other to keep your interest rates as low as possible for as long as possible. And they are using the full force of the United States government to make sure no one else is allowed to offer you a better deal. The war is not being fought with technology. It is being fought with white papers and lobbying dollars. In late 2025, the United States Treasury Department released a highly influential report on the future of digital assets. The report was framed as a neutral, academic analysis. It warned that stablecoins could lead to financial instability and recommended strict new regulations that would effectively limit stablecoin issuance to licensed banks only. But there was a problem with the neutrality of this report. According to public disclosures and investigative reporting, the primary advisors who helped the Treasury Department craft this report were executives from Citigroup and other members of the Treasury Borrowing Advisory Committee. This is the ultimate fox guarding the henhouse scenario. The very people whose business model is being threatened by stablecoins were the ones writing the government's official policy on how to regulate them. The result was a document that read like a wish list for Wall Street. The report suggested that any entity issuing a stablecoin should be forced to follow the same capital requirements as a traditional bank. On the surface, this sounds reasonable. Who wouldn't want more safety? But the devil is in the details. By forcing a stablecoin issuer to become a bank, you force them to take on all the costs of a bank. You force them into the same slow, expensive, and opaque system that they were designed to replace. The goal of the Citigroup advisors was not to make stablecoins safer. It was to make them more expensive. If you can force a stablecoin issuer to spend hundreds of millions of dollars on banking licenses and compliance departments, they can no longer afford to give you that 5% yield. They would be forced to lower their rates to 0.01%, just like the banks. This is the strategy of regulatory capture. When you cannot beat a competitor with a better product, you use the government to raise the cost of doing business until the competitor can no longer offer a better price. But the banking lobby didn't stop at the Treasury Department. They moved to Congress, pushing for a piece of legislation known as the Genius Act. This bill, which stands for the Global Electronic Network Integrity and United States Security Act, contains a hidden provision that would make it illegal for any non-bank stablecoin issuer to pay interest or rewards to its users. If this bill passes, it will be a historic victory for the gatekeepers. It will effectively be a law that says it is illegal for you to receive the market value of your own money unless you go through a bank. It is the legislative equivalent of a monopoly, protected by the full force of federal law. Whenever a billionaire like Jamie Dimon or a CEO from Citigroup goes before Congress to argue against stablecoins, they never talk about their own profits. They know that nobody feels sorry for a bank that made $50 billion in a single year. Instead, they use a tactic known as the human shield. They talk about the community banks. They talk about the small family-owned bank in rural Ohio, or the credit union in a small town in Texas. They argue that if stablecoins are allowed to offer high yields, these small banks will lose their deposits and will no longer be able to provide mortgages to local families or loans to small farmers. It is a powerful emotional argument, and it works on both Republicans and Democrats. But it is fundamentally dishonest. End of quote. The biggest threat to community banks in America has never been crypto. It has always been the big banks themselves. Since 1994, the number of community banks in the United States has declined by more than 70%. They weren't killed by digital tokens. They were systematically destroyed, acquired, or driven out of business by the giant firms that Jamie Dimon runs. The big banks use community banks as a political tool. They hide behind the image of a friendly local banker while they draft laws that favor the largest institutions in the world. The reality is that if stablecoins were legalized and regulated fairly, small banks could actually use them to compete with the big banks. A small bank in Iowa could use stablecoin infrastructure to move money faster and cheaper than JP Morgan. But the big banks don't want a level playing field. They want a world where they are the only ones allowed to hold dollars. They want to ensure that the $17 trillion in American deposits stays trapped in their ecosystem, earning 0% for the people and 5% for the shareholders. The irony is that the big banks are actually the ones who are the most unstable. During the banking crisis of early 2023, it wasn't the small community banks that caused the panic. It was Silicon Valley Bank, Signature Bank, and First Republic. These were massive, sophisticated institutions that failed because they mismanaged their interest rate risk. When these banks failed, the government stepped in with a massive bailout to protect the depositors. The big banks then used this crisis to argue that only they are safe enough to hold your money. They turned their own failure into a marketing campaign for their monopoly. Stablecoins, by contrast, cannot fail in the same way. A regulated stablecoin like USDC is 100% reserved. They don't lend your money out for 30-year mortgages. They don't gamble with it in the derivatives market. They hold it in short-term government debt. If every single USDC holder wanted their money back today, the company would simply sell the treasuries and give everyone their dollars. There is no need for a government bailout. This is the ultimate secret of the war. The banks are fighting against a system that is actually safer and more efficient than their own, because that efficiency would destroy their ability to extract billions of dollars from you every single year. While the lobbyists fight the war in the halls of Congress, the regulators are fighting a quieter war in the backrooms of the banking system. This is what the industry has called Operation Choke Point 2.0. The original Operation Choke Point was a controversial program during the Obama administration, where regulators pressured banks to cut off services to legal but disfavored businesses, like gun sellers and payday lenders. Today, a similar strategy is being used against the entire crypto industry. The goal is simple. If you can't make crypto illegal, you can make it impossible to use by cutting off its connection to the traditional financial system. Over the last 2 years, the SEC and the banking regulators have issued a series of warnings to banks, telling them that dealing with crypto companies is a high-risk activity that will lead to increased scrutiny and higher capital requirements. For a bank, this is a clear message. If you provide a bank account to a crypto exchange or a stablecoin issuer, we will make your life miserable. As a result, many crypto companies have been debanked. They have had their accounts closed with no explanation. They have been forced to move their operations overseas or to use smaller, more expensive banks. This is not about preventing crime. The banking industry itself has been caught moving trillions of dollars for drug cartels, terrorists, and money launderers. According to the United Nations, the amount of money laundered through traditional banks every year is estimated to be between $800 billion and $2 trillion. By comparison, the amount of criminal activity in the crypto space is a tiny fraction of a percent. The real goal of Operation Choke Point 2.0 is to prevent the exit door from opening. If it is difficult and expensive for you to move your money from your bank account to a stablecoin wallet, you are much more likely to just leave your money in the bank. The regulators are creating artificial friction to protect the status quo. In Davos, when Jamie Dimon pointed his finger at Brian Armstrong, he was speaking as the commander-in-chief of this effort. He knows that as long as Coinbase needs a bank account at JP Morgan to operate, JP Morgan has the power to slow them down, charge them high fees, and eventually shut them down. The banks are trying to maintain a world where they are the only ones with the keys to the digital economy. They want to be the gatekeepers of every transaction you make. Stablecoins represent a world where the gates are gone, a world where you can hold your own keys and move your own value without asking for permission. The most insulting part of this war is the sheer hypocrisy of the people fighting it. Jamie Dimon has been one of the most vocal critics of crypto for a decade. He has called Bitcoin a fraud, a pet rock, and a tool for criminals. He has told Congress that the only true use case for digital assets is money laundering and tax evasion. But while he is saying these things to the cameras, his own bank is building a massive crypto infrastructure. JP Morgan has its own internal blockchain platform called Onyx. They have their own stablecoin called JPM Coin. They have a dedicated team of hundreds of developers working on digital asset integration. Jamie Dimon doesn't hate the technology. He loves the technology. He just wants to make sure that his bank is the only one allowed to own it. He wants a world where JP Morgan can use a blockchain to settle multi-billion-dollar trades instantly, saving them millions in fees, while you are still stuck waiting 3 days for a wire transfer to clear. This is a classic case of pulling up the ladder behind you. The big banks want the efficiency of the blockchain for themselves, but they want to keep the inefficiency of the traditional system for you. They want to use digital assets to lower their costs, while continuing to charge you the same high fees and paying you the same low interest rates. And then there is the moral argument. The banks often frame their opposition to stablecoins as a matter of protecting the public from unregulated actors. But who are the regulated actors we are supposed to trust? In the last 5 years, every major US bank has been hit with massive fines for illegal activity. Wells Fargo was caught creating millions of fake accounts. Goldman Sachs paid billions to settle charges related to the 1MDB corruption scandal in Malaysia. And, as mentioned earlier, JP Morgan paid $75 million to settle claims that it facilitated Jeffrey Epstein's sex trafficking ring. These are the institutions that are telling us that stablecoins are too dangerous for the average American. They are telling us that we need their oversight to stay safe. The truth is that the banking system is not designed to be safe. It is designed to be profitable for the people at the top. The 5% interest rate that the government is paying right now is a gift from the taxpayers to the financial elite. It is a massive transfer of wealth from the public to the banks, and stablecoins are the only thing that could stop it. When you hear a banker talk about safety, remember that they are talking about the safety of their bonuses. When they talk about regulation, they are talking about the regulation of their competition. And when they talk about the American economy, they are talking about a system that they have rigged in their favor for generations. We are approaching a tipping point. The technology behind stablecoins is no longer an experiment. It is a proven, multi-trillion-dollar infrastructure that is faster, cheaper, and more transparent than the traditional banking system. The only thing keeping the old system alive is the power of the lobbyist and the inertia of the public. But inertia only lasts until the pain of staying becomes greater than the fear of leaving. Right now, the pain is 5%. Every year that you keep your money in a traditional savings account, you are paying a 5% tax to your bank for the privilege of them using your money. For a family with $20,000 in savings, that is $1,000 a year in lost income. That is a mortgage payment. That is a year of groceries. That is a child's college fund. As inflation continues to eat away at the value of the dollar, people are starting to wake up. They are starting to realize that the old rules no longer apply. The idea that a bank account is the only safe place for your money is a myth that is being debunked by the math of the 21st century. The battle at Davos was just the beginning. In the coming years, you will see more lawsuits, more aggressive legislation, and more fear-mongering from the banking elite. They will try to ban the yields, they will try to shut down the exchanges, and they will try to force you back into their ecosystem. But you cannot ban an interest rate. You cannot ban a more efficient way to move value. And you certainly cannot ban people from wanting to get what they are owed. The bank account as we know it is dying. It is being replaced by digital wallets that are more like a personal vault than a loan to a corporation. In this new world, the role of the bank will be drastically reduced. They will no longer be the gatekeepers of our wealth. They will be what they should have always been, service providers who have to compete for our business. The 5% is out there. It belongs to the people who own the dollars. Jamie Dimon knows this. Citigroup knows this. And now, you know it too. The war for your 5% is not just about money. It is about who owns the future of the financial system. Will it be the people who write the rules behind closed doors in Davos? Or will it be the people who hold the keys in their own pockets? The choice is yours. But remember, the longer you wait to make that choice, the more of your 5% the bank gets to keep. How money works.